Hello, everyone, and welcome to today's webinar on market insights for fixed income, where we will explore the key trends and opportunities shaping the fixed income landscape. I'm Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, head fixed income, who will walk us through the latest market developments and provide valuable insights into the current state of the fixed income market. After Anurag's update, we'll open the session for Q&A segment. You are welcome to submit your questions throughout the webinar via the link provided. Let's dive into the session. Anurag, over to you.
Thanks, Sandeep, and good day, everyone, and thanks for joining in on this webinar. This was a very critical month. For India, this was the first month after the US 25% plus 25% penalty tariff. So, in a way, this was the first month after India was facing the 50% tariff. This was also a month of a US government shutdown. This was also the month when the US and China uh, went into a truce and also agreed to exempt many duties and give many concessions to support global trade. So we'll start with global trends, the key factors which are affecting the market, and then we'll move on to the domestic economy and the right funds to pick in these times. So to start with, global economic activity. On the left-hand side of the slide, you can see the JP Morgan Global PMI, which discusses whether the manufacturing and services sector uh, are they in expansion or in contraction. Any number above 50 is in expansion zone, and a number below 50 shows contraction. And as can be seen from the chart, both the manufacturing and services continue to be in expansionary zone. If you look at the services sector, there was a very slight blip a couple of months back, but since then the service activity has been quite robust and it's quite broad based as well. So broadly, the services continues to remain very strong across the developed markets, especially the US, UK, and Europe area, as Europe tries to spend more, uh, to curb its slowdown. We are seeing strong pickup in economic activity, especially in services. On the manufacturing side as well, for the consecutive third month, manufacturing PMI continues to improve, although slightly below the services sector, but broadly, again, it's a broad-based recovery across US, China, uh, you know, and other Asian economies as well. Although on the forward-looking indicators, if you look at order book and inventory side, although turning slightly softer, but as things stand today, despite all the tariffs and all the economic uncertainty, manufacturing continues to be in expansion zone. If we look at the chart on the right-hand side, which is the Economic Activity Surprise Index, which broadly depicts whether the economic activity is better than consensus expectations. If you look at the US continues to perform strongly, although there's a slight dip below the previous month, but broadly economic activity continues to remain quite strong. Although on the European side, the current data is showing some softening, but broadly it is as per the consensus estimate. So overall data continues to be strong compared to the consensus estimates because of the fiscal in European Union. There were some analysts who were expecting very strong pickup in growth indicators. It's taking some time, but overall activity continues to remain quite supportive of strong growth in Q3 of this calendar year as well. Moving on, we also had the Fed meeting in this month, and as expected, Fed cut its rates by 25 basis to move towards 375 to 4. There was a dissent on both the sides. Fed Governor Stephen Miran, dissented and he voted for a 50 basis cut, whereas Kansas City Fed President Jeffrey Schmidt voted for a status quo, citing that inflation still remains above 2% target. And if you look at the financial conditions, whether you look at credit spreads, equity markets, lending conditions, they continue to be quite easy. AI spending continues to be quite robust. So he did not see any reason for the Fed to cut rates But broadly, the consensus was that the labor market activity at the margin has started to slow down. And like we saw in September also, when the Fed called the rate cut as a risk management, monetary easing. We believe this rate cut also continues to be of similar lines, where just to ensure that there is no major disruption to the labor market, Fed continues to chip in from its side to ensure monetary conditions continue to remain easy. Also, on the quantitative tightening that Fed had instituted post 2022, the Fed also put an end to it. So while uh, the treasury maturities that the Fed will have, Fed will now reinvest those maturities back in treasury securities, whereas the MBS securities, where as and when they get matured, Fed will invest them in T-bills as well. So broadly, the 45 billion runoff that the Fed was seeing, and Fed balance sheet had shrunk quite a lot uh, from the from the normalization after the 2022 rate hiking cycle. Now Fed is again at least starting to maintain its balance sheet at the same level. This is quite constructive for the liquidity, because there were market participants who were feeling the pressure on liquidity as Fed was contracting its balance sheet. The US government was increasing its issuance from the T-bill side, and that was leading to some funding pressure on the short end. So as the Fed reinvests its maturing securities, that should at least at the margin keep liquidity neutral and alleviate some stress in the near term money market rates. Although on the press conference, so while these were good positive aspects, on the press conference, while there were no dot plots, the Fed chair, Mr. Powell, pushed back against December rate cut, where he said that the December rate cut was not a foregone conclusion, and they will want to look at data points, especially in the labor market, to assess whether they want to cut in December also. If you look at the chart on the right hand side, before the FOMC meeting, this basically depicts the probability of December rate cut based on interest rate swaps. And if you can look at the chart just before the meeting, the market was giving 100% probability of a December rate cut. So there was a consensus estimate that given the way we are seeing job losses, especially in the organized sector in the US. Probably Fed will want to cut more, and Fed will continue to cut after September, October, and now in December as well. And so broadly, the statement by the Fed chair pushed back against that market expectation. And why we think it was needed and why we support that pushback is, given that we are in a data flux, given the government shutdown, the Fed is not getting any data on inflation or on labor market. While it will have access to some private sector data, but that will probably not be enough for Fed to take an aggressive rate call. Mind you, as the Fed has been saying that while economic activity is declining from its high levels, inflation also continues to be above 2%. So probably Fed wants to be sure uh, before they cut rates. And given the way market pricing was built in for a consensus rate cut, they just wanted to probably ensure that risk to the rate cut view are two-sided, and it's not a done deal. And probably Fed will take data into account. Although at UTI, we still think that there is a very strong probability that Fed will cut rates in December as well. If you look at the private sector labor market data, that continues to deteriorate at the margin. If you look at the tariff pass through on inflation, it's quite limited. In fact, even the Fed chair said that while core inflation is running around 2.5%, if we strip out the tariffs, is running around 2.1%. So broadly, even core inflation is very close to the Fed's mandate of 2%. And tariff, given that it's a one-time shock, it gets adjusted in the base next year. We don't think that Fed will take any major inferences from the tariff-related inflation, and probably they will still cut going ahead in December. It's just that they wanted to kind of ensure that the market pricing is more rational, market expectations become more realistic, that there can still be a two-way reaction. Because if the Fed wouldn't have pushed against the December rate cut expectation, probably the bond market would have gone really in a constructive and an overbought situation in December, and any data surprise could have again led to a lot of bond market volatility, which Fed wanted to rightly avoid. So while we support this pushback in December rate cut, we still think that a December rate cut is a reasonably high probability. And again, the most important, I would say, news in the whole month of October, against the Asia Pacific Economic Council meeting in South Korea, we also had the President Trump and President Xi Jinping meeting in South Korea, Busan, where President Trump described it as a G2 summit. And broadly, there were a lot of disconnect between the US and China before this meeting. There were allegations by the US that China is not doing anything to curb the exports of fentanyl compound. So fentanyl compound is basically kind of a drug which the US alleges that it gets exported from China and then through Mexico to the US, which results in death of about 70,000 Americans every year. So the deaths from fentanyl are higher than deaths from any car crashes, gun violence, and the biggest source of deaths for Americans. So that's what something which President Trump has been talking about, even in the first term and even in the second term, and that has been a bone of contention, and that's what led the U.S. president to levy 20% additional tariff over and above the tariffs on China, which the US had been putting. So, firstly, the US removed the 10% fentanyl tariff, and only now the 10% tariff because of fentanyl curbs is now being levied on China. And China, on its part, also tried to assure the US that it will take countermeasures. As they announced it on 4th of March earlier also, that they will ensure more stringent checks that it does not get exported towards the US. Even the raw materials which go in towards production of fentanyl, that also China will try to ensure that the production is very well controlled and any export is well monitored. Secondly, China had levied an additional 24% tariff on U.S. exports, and China used to import a lot of soybeans and other agriculture products from the U.S., where China has said that they will extend that for a year. So for a year, there will be no tariff on that extra 24% tariff on the U.S. Mind you, China had levied post-Liberation Day about 15% tariffs on U.S. agriculture products, and there was an additional tariff on US oil and gas also. So there was no clarity whether China has removed that as well. There was no statement either from the Chinese side or from the American side. So we will continue to assume that levies remain still in place, but those levies are not really material. Secondly, and something which had really escalated tensions between US and China. So in September, US had announced a 50% affiliate rule that because typical Chinese companies are owned in a layer of companies, and even if you ban one entity, there are a lot of associate companies that any Chinese company would have. So there was a certain export ban from the US, especially related to the chips, and other technological know-how. And in September, US had extended that ban to the affiliate. So any entity where the banned entity would have a 50% stake would also be subject to those export restrictions. So US decided to suspend that 50% affiliate rule for 1 year, which was a very major bone of contention for China. China, on its part, also suspended the export of rare earths to the US. Just to give perspective, China currently today processes 90% of the world's rare earths, which is very, very widely used in the EV sector, in the defense sector, and many critical industries for the US and for rest of the world. So China, on its side, also as US took this confidence building measure, China also decided to suspend those restrictions for a year. Uh, while China has reduced or suspended those restrictions, the exporting entities from China will continue to be monitored. So, some months back, China had also introduced a rule that any rare earth export has to be registered with the Chinese government, and it will be monitored before it goes out of the country. So that rule will China will continue. So China will still monitor what exactly US is importing, but at least there is no suspension, there is no restriction on exports to the US. Both the countries also had decided to put additional shipping fees on ships originating from the US and China, respectively. So that also has been suspended for a year. For soya bean, which was a very, very big political issue in the US, China has promised to buy 12 million tons of soya beans this year and 25 million tons for the next 3 years. So while this number looks high, the typical Chinese soybean purchase has been in the range of 27 to 28 million, regardless of the trade agreement. So largely, China is reverting back to its historical soybean purchase, which it has been doing from the US from time to time. So broadly, this is a normalization, not additional purchase. Although China did say that they will also look to buy other farm products and also oil and gas from Alaska. There's a Chinese and American joint venture on oil and gas in Alaska, which has been in a way shut down. There is no additional purchase uh, from China on the oil and gas side. This is what China has said. So broadly, and also US decided to uh, said that they will also, from its side, on they will loosen some restrictions on TikTok as well, which earlier the U.S. government was, quite adamant that the Chinese ownership of the application of TikTok will have to go away. Probably now U.S. will relax on that as well. So overall, in a nutshell, both sides have in a way suspended their hostilities for a year. And if you look at the overall, tariff reduction for China, it's a very, very positive, outcome for China, because now the effective tariff, although the headline tariff for China still stands at 47%, but because of various exemptions now, the actual Chinese effective tariff is now 30%, which is very, very close to now other ASEAN countries of 20%. So broadly, if you look at the trend rate since Liberation Day, what was happening was there was a lot of transshipment going from China to other ASEAN economies, which were in turn exporting to the US. So just to give an example, in the first 9 months of 2025, Chinese exports to the US had fallen by 17%, but their exports to ASEAN countries, which is like Indonesia, Philippines, Malaysia, etc., they had grown by 14.7%. So probably the exporters will be able to directly now export from China to the US, because at a 10% differential, given the way the export infrastructure is built in China, it's much more viable to directly export from China even at a 10% higher tariff. So overall, it's very, very positive for China, and no controversial topic was touched during the discussion, uh, such as Taiwan or Russia. So both the parties stayed away from talking about any geopolitical controversy. The president has invited Xi Jinping to the US. Probably they will meet next time on the sidelines of G20 in May. So it gives both the parties for some time to to kind of conclude their trade negotiations on a more long-term basis. And given that next year, by the time this one-year truce ends next year in November 26, US will be entering a period of midterm elections. So that's also probably a time when US would have liked to close its long-term negotiations with China on the trade side. So we do expect that probably the next year, US and China will be able to resolve their differences, at least on the trade side, which will give more certainty to financial markets as well. On the commodity prices, gold and silver continue to do quite well. So while oil prices, fell as market participants still see very strong supply, both from the US and from OPEC, but the rise in gold and silver prices offset that fall, and also copper prices continue to climb up on expected demand from AI related capital spending on data centers especially, and also as US China truce happened, now market participants expect Chinese growth to pick up from current levels, and hence metal demand to remain strong in the next year. On the food prices part, the global food prices, remained moderate in September as cereal and dairy prices continue to remain, quite well supplied. And any the price, in fact, on the pricing side, it is looking to on slightly on the weaker footing. And if you look at the duration, performance in the month of October, broadly, if you look at, the advanced economies, whether we look at US, UK, Germany, etc., broadly, we saw a rally led by the rate cuts from the Federal Reserve. So as market participants expect more rate cuts from the Federal Reserve, so while Fed did push back from the December rate cut, but the broad theme of further monetary easing from the Fed remains intact, and hence we saw a secular rally across the advanced economies, whereas on the emerging markets, yields kind of diverse depending on the domestic macro. So, for example, if you look at South Korea, where there's an expectation of higher fiscal spending, we saw some pickup in bond yields. If you look at Brazil or Mexico also, where there are expectations of higher inflation as well as higher fiscal spending, we saw some jump in bond yields. Whereas if you look at India and Indonesia, where there is expectation of some, hit on the growth, we saw bond yields, declining in the month of October. On the financial conditions, like we discussed in one of the previous slides, as one of the Fed, governors also noted that financial conditions continue to remain quite easy. So while yes, the 10-year is still above 5%, sorry 4%, but if you look at the other financial conditions, such as equity valuations, credit spreads, etc., they continue to remain quite tight. That means there is very little pickup for taking additional credit risk, which reflects market participants' sanguine outlook on overall growth, which gives them higher confidence to buy credit at a very tight pricing. If you look at money market, like I was discussing in one of the previous slides, money market rates will be inching up slightly higher, but now with the closure of QT and Fed maintaining its balance sheet, probably we should see more pickup in liquidity, and money market rates should become stable going forward. So that was broadly which we wanted to discuss on global macro. Largely, we do expect Fed to continue its rate cuts as labor market softens. We do expect that as the US-China truce happens, it's not only positive for global growth as global volumes will pick up. It's also slightly positive for US inflation as tariff rates come down. It gives more certainty to producers and exporters in China and rest of the world. So broadly, it's positive for US inflation and gives more leg room for the Fed to cut rates in the next 6 to 12 months. So now coming to domestic trends. So there has been a lot of discussion that what's the impact of GST, rate reductions on the growth outlook. And there is one sector which is the auto sector where the GST pass through has been full, where basically the auto companies have passed on the full benefits of GST cuts to the consumers. And one of the ways to look at the effect of GST, because the GST cuts, or the at least the intention to cut GST was announced on 15th of August during the Independence Day speech by the Honorable PM. There was a slight waiting period by customers where they waited for the actual GST rate cuts before doing any purchases. So broadly, from a period of 15th of August till the 22nd September, till the GST rates were actually announced, there was very little pickup in purchases. And broadly from 22nd September was when the purchasing started to happening. So what we have done is we have taken a period from 1st of August till 31st of October, which will kind of, and we have compared the year on year data, which will kind of reflect the total impact of the GST rate cuts on the, buying by consumers. And if you look at the chart on the right hand side, overall, we are seeing a very sanguine picture uh, of, rural demand. So if you look at two-wheeler sales, they are up 26% on a very high base of 13.5%. If you look at tractor sales also, they are up about 17% although on a small base of 0.9%. And car sales continue to remain strong. I mean, they're up about 8%. So broadly, we are seeing some pickup in consumption wherever we are seeing pass through of GST cut, benefits. If you look at the IIP numbers also, IIP number was also quite strong, where we saw that IIP grew by 4% in September compared to 4.1% in the month of August. Although at a headline level, it's a slight decline, but we have to keep in mind that mining, which has a reasonable weight in IIP, actually saw a decline in the month of September, where mining fell from 6.6% in August to minus 0.4% in September, because there were some sections in India, especially on the eastern side, where we saw excess rainfall and mining operations were affected in those regions. And that's why we saw some slowdown in the mining. So we do expect mining to pick up in subsequent months. But if you look at the manufacturing sector behaved quite well, where it grew from 3.8 to 4.8%. If you look at the use-based, categorization as well, if you look at consumer durables went from 3.5% to 10.2%, which shows, expectations of strong consumption spending and broadly manufacturing firms, raising production of durable firms in anticipation of that demand. If you look at the infrastructure or construction goods as well, that also continue to remain in double digits. So infrastructure goods grew from 10.4% in the month of August to 10.5% on good government spending. So broadly, government spending continues to remain strong. Consumer durables also remain strong. On the consumer non-durables, which was expected, because the consumer non-durables are largely not affected by either interest rate cuts too much or GST cuts as well, because largely they are essentials. Uh, they continue to be in contractionary territory, but if you look at the delta from the month of August, that also shows a lot of improvement, where consumer non-durables have reduced their growth, negative growth from minus 6.4% to minus 2.9% for the month of September. So broadly, the positive step taken by the government of GST rationalization is showing, at least in the initial phases, very optimistic demand outlook from most of the sectors. So we do expect growth outlook for this quarter, which is the October to December quarter, also to remain quite on the stronger side, which also from a rate perspective leads us to believe that there is not too much space of policy easing from the RBI. On the trade side, like I had mentioned in the beginning of my presentation, this was the first month after 50% penalty on India on trade, and as we can see, the trade deficit widened, although it widened largely on very high gold imports. So if you look at the gold imports, they rose from $5.4 billion to $9.6 billion, largely due to festive demand. But we also saw Indian exports to the US declining by 12%, while India did export higher to China and to UAE, which kind of offsets. So if you look at the non-oil exports as well, they grew from 30.6 to 31.4. So broadly, the hit that India got in terms of exports to the US, India tried to compensate for it, and it successfully was able to diversify away from the US in the month of September. We need to see whether India can continue on that path, but our base case is probably uh, there will be some impact on Indian exports. We have discussed that in previous presentations. So we do expect overall trade deficit to become you know uh, slightly over 1% for the current account deficit to be slightly over 1% for the month for the fiscal year 2025-26. On the fiscal side, the tax collections continue to remain quite modest. So if you look at gross tax revenues, they grew at only 2.8% compared to the budgeted estimates of 12.5%. One of the main reasons for lower growth in tax revenue is that we saw income tax cuts at the beginning of the fiscal year. We also saw GST rationalization, and more importantly, this year, the nominal GDP is expected to grow between 8 to 8.5% because of lower inflation. Mind you, the nominal GDP is a sum total of real GDP plus inflation. So as inflation continues to be on the lower side, your nominal GDP is also trending lower. And largely your tax collections are a function of your nominal GDP. So as your nominal GDP is low around 8.5% compared to the budgeted estimate of 10.5%, that's leading to lower tax collections. On the expenditure side, if we can see, largely the capital expenditure is a trend and in line with the budgeted estimates. So broadly, we do expect government to meet its capex targets, but we do expect government to cut down on its revenue expenditure in the second half of the fiscal year. If it wants to adhere to the fiscal deficit target, we do expect that the government will adhere to its fiscal deficit target, and probably from a growth outlook perspective, the best of government spending and the best of government support to growth in fiscal year 2026 is behind us. So largely, the benefits of growth will come through consumption rather than through government spending. On the credit growth side, credit growth has picked up. So if you look at non-food credit growth, it has picked up from 10.2% to 11.3%. More importantly, the credit deposit gap has started to widen. So your deposit, credit growth, which was typically at 9.5, 10%, and deposit growth was around 9.5%. So the credit deposit ratio was around 78%. But if you look at the indicators in the last month, as economic activity has picked up, as consumption has picked up, credit growth has improved to 11.3%, and we do expect credit growth to remain in double digits at least in the next 3 to 4 months. And if you look at the now loan to deposit ratio, it has gone from 78% broadly to 80%, and that also has a bearing on money market rate. So as credit deposit ratio climbs up, probably banks will want to issue more CDs to fund their credit requirement, which which should keep the spread between 3 months, 6 months, over 1 year CDs slightly higher. So probably, from a positioning and fund perspective, your for investors, we do expect that money market yields or ultra short-term yields will remain on the slightly on the higher side compared to liquid and overnight funds. We talked about credit growth. If you look at the corporate bond issuance, the corporate bond issuance as for first half of 2026 has largely remained flat, as now because of rate cuts, the MCLR rates and the linked loan rate, linked rates which are linked to T-bills, etc., have really come down. So broadly, what corporates are doing, the corporates are now moving to banks from capital market as a transmission in the banking system. Loans have been quite sharp, and hence what we are seeing is, if you look at the overall issuance of the debt in H1 FY26 compared to H125, it's largely remained stable at about 4.6 lakh crores. But if you look at the issuance pattern, that's become very interesting. So if you look at the previous year, the up to 3 year issuance was about 1 lakh crores out of 4.54 lakh crores. But if you look at this year, the issuance in the 3 year segment is now 2 lakh crores, which is almost 45% of the total issuance. So borrowers are borrowing more on the 3 year side as they take advantage of better liquidity and those rate cuts. Uh, compared to what we saw in the previous year, because what was happening in the previous year, the buyers were anticipating rate cuts, so there was a lot of demand in the 10 year, and that's why corporates were happy to issue in the 10 year space. But this year, what's happening is, as the rate cuts have already materialized, the issuance and the demand in the 10 year space has come down. What's also interesting about this is, if you look at the chart on the right hand side, which reflects the 3 year AAA over 3 year G6 spread. Because of this issuance, the spread has widened, from about 50, 55 basis now to 65 basis. Whereas if you look at on the 10 years side, the spread has actually narrowed from almost 75 basis to 45 basis. So we do expect those, spreads to go up again. So as more SDL supply comes in the second half, more longer supply comes onto the GSEC side in second half, we do expect 10-year spreads over the 10-year GSEC to widen, uh, especially if investors are to get SDLs at higher or slightly even similar levels at corporate bonds, which is a SLR security. We could see some pressure on the 10-year space as well. So from a valuation perspective, we have seen decent margin of safety in the 3 year segment compared to the 10-year segment. If you look at the sovereign curve, as we have been discussing for a while now, that as rate cut cycle comes to an end, typically we see steepening of the curve where market participants tend to prefer the short to medium end, whereas on the long end side, typically uh, curve tends to steepen as participants stay away from long end the yield curve. That's largely what happened in the month of October. If you can see, the yield on the 10, 15 year, 30 year, 40 year, etc. went up, whereas yield on the 5 year to 10 year went down, as market participants are taking from a theme of lower for longer rates, easy liquidity, and hence they're able to anchor their short-term investments to the current repo rate, whereas the long end continues to suffer. Uh, that as the most of the rate cuts happen, and as market participants are seeing pressure on the tax collection, that's also reflecting on the longer term interest rates. Largely, this is the same, movement that we have been talking about. Basically, this slide talks about the movement across the curve 1, 3, 5, and 10 year. So, for example, if you look at the 3 year space, we are seeing a triple eight have remained largely flat compared to last month, whereas the 3 year GSEC went up. But if you look at the 5 year side, on the 5 year GSEC rates went down. On the AAA, in fact, they went up. So largely on the corporate bond side, now market participants are largely looking at now the 3 year space as they become more comfortable with liquidity. So broadly on the outlook, we do expect, there is probably a possibility of one more rate cut in December, as inflation continues to remain low, while growth momentum is slightly moderating due to the tariff-related uncertainties with the US. even if the tomorrow India-US tariff negotiations were to fructify, and there would be a better tariff outlook for India. At least that will take at least 1.5 months to show in growth outlook. So for at least the month of November and December, we do expect these external headwinds on exports to continue. And also, like we said in one of the previous discussions on the fiscal side, because of lower tax collection, we do expect government spending to slow down in the second half of the fiscal year as well, which will weigh in on growth. So, in a nutshell, we do expect space for rate cuts, but there's a very limited space because despite all of this, growth is still expected to be around 6.5%, while next year inflation should reverse the lows that it is seeing this year and probably steady around 4.5%. In this kind of a situation where liquidity remains easy, where your growth is stable and your inflation is also stable at 4.5%, we are seeing a lower for longer rate outlook, and hence we expect short to medium end of the yield curve to remain quite
इसकी आवाज चली
attractive.
गई अनुराग.
And so from a portfolio standpoint, we are constructive on the moderate duration, which is the 2 to 5 year segment. We are also constructive on selective credit names, which are well managed NBFCs and strong promoter groups. We should also get supported by funding cost and system level liquidity. I did mention that now corporate issuance is remaining flat despite easy liquidity and rate cuts. So we do expect corporate bond issuance to remain muted, and hence, given the lower supply, we are constructive on selective credit names as well. Like I said, on the longer duration side, given the fiscal headwinds that the government is expected to face in the next 2 3 years, we believe that one can stay underweight or rebalance from longer duration to shorter or moderate duration segment. So broadly, if an investor has a 6 to 12 months horizon, they can consider money market or low duration strategies. If an investor has a 12-month horizon, so broadly they can take slightly higher volatility. They can consider moderate duration, but high credit quality products like short-term or corporate bond funds. And if an investor has investment horizon of more than 2 years, then the income plus arbitrage funds is very attractive for investor for tax efficiency. So broadly, that's our tax. Uh, Given the tax outlook, we think the income plus arbitrage is more suited for investors with more than 2 year investment horizon. So I'll stop here and I'll request Sandeep to open the floor to questions, and we're happy to address all the queries that investors have.
All right. Thanks, Anurag, for sharing the insights in these details. Let us start with the Q&A session. So the first question is, how does global environment currently shape Indian bond yields?
So, global environment, like mentioned at the beginning, it's right now in a way a standstill because you are seeing some slowdown at the margin in Eurozone. But the initial, effect of tariffs that many economists and market participants thought that will be quite growth negative, not being very disruptive to global growth, as most of the cost is being borne by, some shared by between exporters and importers with very limited cost now, as of now, passed on to consumers. At the same time, when US-China truce is happening, that's overall positive from a global growth outlook, as China contributes a large part of global growth. So while there could be some weakness in the European sector, overall, because of U.S.-China better relations, we are likely to see overall stable growth in the next 12 to 18 months. For India per se, the biggest delta uh, in the next 3 to 6 months will be how the negotiations with the US pan out. So if India is able to conclude a trade deal with the US, which at least removes the 25% penalty which India has been imposed with because of Russian crude oil purchase, probably that could create some more tailwind for India on the growth outlook side. But you know The base case is at some point of time in the next 3 months, India should be able to conclude a favorable trade deal than it has right now with the US, and that should support growth drivers in the next 12 to 18 months as well.
Okay. The next question is from Miss Madhurima Saha. Is there any chance of global market crash in upcoming year due to de-dollarization and other factors in USA? And how much impact would be there on the Indian economy if the US market crashes?
So, what we have learned from various crashes, whether it was in 1987, whether it was in 2001 .com, or whether it was the 2008 global financial crisis, or it was the 2020 COVID-related, you know, volatility. Typically, you know, there is always a possibility of something happening in the global markets given their interconnected nature, but it's very difficult to forecast the exact timing because there are some long-term trends which take time to play out, and those long-term trends are also in a way mitigated by the actions of the government and by the central banks. So if the central banks and the government act timely, then many of the disruptions can be avoided. So there could be some fundamental reasons in anyone's mind for disruption, but if the government is able to proactively take some measures to ensure that you know the effect on the economy and the market is minimal, these overall the intended disruption may not never play out, or it may play out in a very very long time. So it's very difficult to say when crash can happen, what will be the reason. It's anyone's guess. It can happen in the next 1 year. It may not happen for the next 10 years also. So it's very difficult to really pinpoint the timing or the extent of crash, and hence it's very difficult to also forecast what will be the impact of India. If the crash is more localized, it's because of some local issues. Probably the impact on India will be very very minimal. If the overall any let's say market disruption is due to trade related or global growth related, then probably India may also get impacted. So it depends on the reason of the crash. As far as the one part that you mentioned was de-dollarization, we are not really seeing any signs of de-dollarization in global economy as of now. US dollar continues to be the most favored currency for trade, for central banking reserves as well. Thank you.
Okay. So the next question is, where do real interest rates in India stand today, and what does that imply for investors?
So if you look at the real interest rates, there are two ways to look at real interest rates. One is the ex post real interest rates, which are broadly realized interest rates, which depend on the current inflation and the actual interest rate prevailing in the economy. So if you look at for example, the repo rate at 5.5 and take the last inflation around 1%, the realized or the ex post interest rate or real rate is about 4.5%. Typically, central banks are forward looking and they always take into account the expected inflation and the inflation expectation for deriving real interest rates. So, if you look at the central bank expectation of 4.5% inflation and look at 5.5% repo, the real interest rate is about 100 basis. For implication for Indian investors, largely the what investors ultimately or what market cares about is the forward looking or the ex ante real interest rates, which is around 100 basis and which is slightly on the lower side compared to its historical ranges because RBI is trying to ensure that it's able to support growth and it's keeping rates slightly on the accommodative side.
Okay. Thanks, Anurag. We'll take one last question. What is the current trend in the credit spreads, and how might it evolve going forward?
So, like we discussed in one of the previous slides, the corporate bond issuance as of now is slowing down or largely remaining at the previous levels because now the corporates are getting much better pricing from banks rather than capital markets. If you look at the current initiatives taken by the central bank in the previous October policy, where they have given some relaxations on bank funding for M&A activity, bank funding for real estate activity, etc. We in fact expect more corporates to go to banks rather than come to NBFCs or come to capital markets for more lending. So we do expect credit spreads to remain tight, or in fact even may narrow for some issuers where because of lack of supply and easy liquidity in the system, there could be more chase for accrual and more chase for yields. And quality issuers may see some more spread compression as well. So when I say credit spreads, um, you know, credit is not a homogeneous market; it's a heterogeneous market. So there are some issuers which are backed by very strong promoters. There are stable sectors. Probably they will see some more compression. Companies which are not backed by very strong promoters or in very volatile sectors may not see meaningful spread compression because of the risk associated with those kind of investments.
All right, Anurag. Thanks, Anurag, for answering all the questions. And thank you, everyone, for being with us today. We hope Anurag's perspective offered valuable insights in the fixed income space and the road ahead. We look forward to connecting again soon. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.